Last night. All right, so this morning I'm going to talk to you about Northern Trust's views on the markets, both long-term, so 5-year plus kind of horizon, and then also tactically how we're thinking about the world. So when you've got fresh money that you've got to assess how you manage, whether it's money coming in or money flowing out, how you might consider taking the current market environment into consideration in implementing those kind of portfolio moves. I want to spend a quick second talking about the goals of the session. So first, talking about the strategic themes. Themes are something we think are very helpful in filtering out all the noise that we get bombarded with on a daily basis, and what it means for long-term returns for the portfolios. And the quick takeaway on this is we've had a relatively good environment over the last 5 years where a 60-40 kind of portfolio has delivered nearly a 7% return. We think that should be viewed more moderately over the next 5 years with a return expectation just above 5. So preparation for more moderate returns is a key message that we are sending to clients. Second is tactical opportunities and how we'd position portfolios. We do think that it's still an environment that's worth taking risk. I'll lead you through what we did in 2018, which was a year of de-risking, and then getting back into the markets pretty noticeably in January of 2019. So we're comfortable being overweight risk here today. And then lastly, talk about risk cases, and then I think an interesting experiment, which is lessons learned, going back and looking at what we forecasted 5 years ago for the long-term return expectations, what actually transpired, and lessons that can be taken from that review. So first, let me spend a minute talking about how we look at the process of the capital markets assumptions and the asset allocation. We're big believers in the importance of having a disciplined process that follows a regular schedule to reduce the risk that you are buffeted by what's going on in the markets and follow normal human behavioral aspects where you're at greater risk of reacting as opposed to anticipating. It's something that we do every summer, publish them late summer, and we'd be happy to provide those updated views. I think from a timing standpoint, they're very timely as people get towards year end and think about their plans for the next year or next 5 years. And a couple other points I'd make is that we're big believers in having both a quantitative and a qualitative approach. You can run all the models in the world, but they generally assume that the world reverts to the mean. And one of the big lessons after the financial crisis is that we're in a different environment. So if you were expecting cash to deliver a historic return after the financial crisis, which the models would have told you, that was a very disappointing outcome. So having a fundamental bottoms-up view to match against that is a really helpful construct. I would say the other thing that's important in how we go about this is that we're a team of investors. So we manage about $1.3 trillion across equities, fixed income, and alternatives. And the people who manage those assets are my team that help us develop these long-term views. And then from a tactical standpoint, every single month, once a month, we will meet and discuss the outlook for risk-taking. What's changed, because trying to forecast out 5 years is a challenging topic, and things change. You get a new set of tariffs, you get new inflation data, you get new monetary policy, and so being able to provide a monthly outlook on what would you do with fresh money today is something that's very helpful. And again, this issue of being disciplined around the process is critical. In the 14 years I've led this group, we've had 2 ad hoc meetings in response to things going on in the marketplace, and we're 1 for 2 on whether it was a good idea to have those meetings. After Lehman reduced risk further, which paid off, but during the European financial crisis in 2011, took risk off the table. The European Central Bank came out 3 days later, and European stocks took off. So we got a very high bar for considering ad hoc actions because history suggests that it just, again, increases the odds of reacting instead of anticipating. So let me start with the themes. And I started out in the earlier stage of my career analyzing equities, and I was kind of a bit of a skeptic on themes. They just seemed a little too airy for me. But I've really grown to appreciate the value. And so it's not just their ability to help you forecast what the economy or the markets are going to do. They're a great communication device, not only to help you filter data, but to talk to investment committees. This is what is driving the economy. This is what's driving the markets. This is why we're positioned in our portfolios the way we're positioned. And so continually coming back to recurring themes is a way to keep people in their seats. And so we've always got a theme on the top three topics: growth, inflation, and monetary policy. So let me hit those this morning. So the first theme is called mild growth myopia. And that is a reflection that many investors are too focused on how long the expansion has been underway without enough focus on what's actually been accomplished. So as of last summer, the expansion had gone on 108 months, relatively long. If it continued for the next 5 years, 168 months, blowing away the length of prior expansions. So some people will say it's only a matter of time before this ends. But we think that actually, if you look at what has been accomplished from a growth standpoint, as of this past summer, so if we update it to current state, we're probably at 48% growth. That is way below the amount of growth that we realized in the 80s and 90 expansions. And at 5 more years, we will get to 71% cumulative growth. So that will get us towards a normal level of expansion. So we think that the expansion is more durable than people fear. So let's talk about the current environment. Everyone was worried about growth. What happened in the first quarter of this year? Just reported over the weekend, Japan grew 2.1%. Europe grew 1.5%, the US grew 3.2%. That doesn't seem like a global economy that's rolling over. The second theme is one that I'm particularly proud of. Some of you, I'm sure, have heard of our theme of stuckflation, which is a play on the concept of stagflation. But it's a recognition that inflation has been way below central banker policy ever since the financial crisis. So cumulative price increases in the United States were expected to be at around 22%. We're only at 16%. We're in better shape than many countries. Look at Japan. Japanese prices are 20% below what the policymakers had been trying to achieve. So why do we care about this, and what is it driven by? We care about it because the policymakers are worried the next time the economy starts to slow down that we may start worrying about the deflation risk again, which is bad for investment returns, really bad for the economy. What is leading to this? We think it has been for years now the impact of technology, bringing new supply into industries, and that prevents pricing power from taking hold. So whether it's Uber or Amazon or Airbnb, the examples are replete. But the most clear demonstration of this that I can offer is the transportation business with the Ubers, and if you go to the Middle East, it's Careem, or you go to China and it's Didi. They are bringing all of this underused capacity in automobiles into the economy, to the extent that BMW thinks in 10 years' time that one of these sharing economy cars will replace 3 privately owned cars. That's how BMW is running their business to adjust for that dramatic change. That's maybe the biggest industry in the world, and they're going to have pricing pressure. So we're pretty confident in this issue of inflation staying low for long. Now, of course, that has got big implications for monetary policy. And our theme on monetary policy is called pass-fail monetarism, and it gets to the issue of interest rates are going to take a long time to get back to normal. Last year, our theme to try and capture that was called Waiting for Monetary Godot. But our millennial partners kept asking who Godot was, so we had to come up with a new name for the theme. So pass-fail monetarism gets to the issue that we are in a lower interest rate environment, that is likely to persist for a long time. And the risk is that central banks prematurely end the expansion by trying to create dry powder for the next recession, and that they, in effect, accelerate the inevitable. And part of the concern around that is that we clearly are at a time of less dry powder in the tank. But this is in a lower interest rate environment where if the Fed was to come in and cut interest rates 2.5% in a low interest rate environment, that is more stimulative than when you're in a high interest rate environment like we were in the prior cycles. So our view is that the Fed and the European Central Bank, the Bank of Japan, are going to end up staying low for long. Our forecast for the 10-year Treasury, for example, is that it is going to be below 3% in 5 years' time. And stagflation will be a key element that allows that to persist. So what does this mean for asset class forecasts? Some of these might be a touch hard to read. We'd be happy to provide electronic copies if you're not getting them to anyone that would like. But again, the message is a 60-40 portfolio, just as a benchmark, nearly 7% return. We look at one of being around 5.2 going forward. I'm going to hit a couple of the key asset classes going forward, but the areas that we see the best return potential include emerging market equities and private equities. So the differential in return expectations is really a confluence of fighting elements. Lower equity returns, but better fixed income returns because interest rates are higher today than what we've experienced over the last 5 years. Now, I mentioned that we expect rates to stay low for long. These are just the three different curves going out. Message is rates are going to be low. And from an equity return standpoint, one of the key messages is dividend yields will be a measurably larger percent of total return. So in a low interest rate environment, the return from dividends that you can get out of the UK, out of Australia, even out of Europe, think about Europe with a 3% dividend yield and a negative 10 basis point yield on the German 10-year bond. That is going to support equities and make that bit of a lower return, lower risk return profile. Now, I've told you that we don't expect inflation to be a problem, but we still think that investors should have exposure to real assets, and that's really a hedge. It's a hedge against the risk that we're wrong and that inflation does come back. And so in looking at what gives you the best protection, it is commodities and natural resources. It is listed infrastructure, inflation-protected securities being the best performers. But one of the things that we've had a great success in the last 7 or 8 years, very high client satisfaction, is moving people from futures-based commodity strategies to an equity-based approach. That's what this natural resources category is. It gives you almost the exact same level of inflation protection, but if you look at the rolling 5-year returns of owning the equities of natural resource producers versus a futures-based commodity strategy, it has outperformed every period. And it's outperformed with multiple hundreds of basis points annually. So for those thinking about commodity and natural resource exposure, this is an area that I'd suggest you do some work. On the private equity and hedge fund side, we're still believers in the benefits of private equity. We do think companies are staying private longer, and we want to focus, though, in the areas that are showing better discipline from a pricing standpoint and better discipline from a leverage standpoint. And to us, that's the small and mid-size private equity managers. And then lastly, on the hedge fund side, clearly there's been a major diminution in alpha generation out of hedge funds since the heyday of the 2000s. And the clients that we find with the greatest satisfaction in hedge funds are those that have got a very clearly defined objective, and that objective can be something like reduce the interest rate exposure in my portfolio because I don't want to own as much bond exposure, but give me low volatility like investment grade bonds. So a very targeted hedge fund exposure has really generally met its objective and had satisfied clients. Where there's been the biggest dissatisfaction is the old approach of, I want equity-like returns with bond-like volatility. I think that's just a strategy that's really no longer feasible. So let me talk about the tactical positioning and a quick logistics question. Is there time for questions at the end?
Oh, no.
Okay. All right, well, that'll give me a few more minutes. All right, so let's talk about tactical positioning and how we're thinking about the world. So as we came through 2018, it was a year of steadily de-risking the portfolios. And there's a lot of data on this slide, but I'll run you through the graph up top because it's pretty easy to understand. The more volatile light line is what the global equity markets did. And then the stair-step down line is the active risk we were recommending as the year progressed. So basically, we had 5 different episodes of reducing risk exposure through September, and then a final one in October, because we felt that investors were too optimistic about growth, and we felt the Fed was going to blow it. So what did we end up experiencing? Big sell-off in the fourth quarter, which addressed the first issue. Investors being disappointed about growth, well, that got priced in the fourth quarter. The second issue was the Fed blowing it. Well, they finally pivoted in January, and that's when we said, all right, we've had our 2 big concerns addressed, and it's time to put some risk back into the portfolios. So far, so good. Now, how do we look at the world now that we've got this kind of positioning in place? So the growth outlook, which was a key driver, did shift from boom to gloom. So this is a chart of the Economic Surprise Index in the United States, which had steadily deteriorated really over the last year. But again, remember those GDP reports that I mentioned from the first quarter. People got overly pessimistic, and the economy is going to keep expanding until something comes in to interrupt it. So we think that the growth outlook looks strongest in the U.S. We also think emerging markets will outperform, and a recent upgrade has been the European economies, which we think people are overly pessimistic about. Not that they're taking off, not that the global economy is ready to have a material upcycle, but we just think people got too pessimistic. And then the issue of the Fed, and the Fed backing off. What I've charted here is a measure of risk appetite, which is credit spreads, and then an expectation of Fed policy. And clearly, as risk aversion rose in the fourth quarter, the market started to bet the Fed was going to back off. And then they finally forced that to happen in January. And we're now in a situation where the market actually has a 75% probability built in that the Fed is going to cut rates this year. The Fed's nowhere near close to saying that, but the market's ahead of them in anticipating that that's the more likely outcome. We think they could actually cut rates twice over the next 6 to 12 months. And it's not because the economy is going to deteriorate, but they raised rates too much. One measure of that is the interest rate sensitive parts of the economy. If you look at what they did from a performance standpoint, home building stocks down 25% in 2018. Soon as the Fed pivots, home builders rallied 25%. That's a very clear indication of the impact that the interest rate sensitive sectors feel from what the Fed ends up doing. And there was an opportunity created in the credit markets also in the fourth quarter. So this is a chart of investment grade and high yield spreads. And a lot of people were commenting that high yield looked like it was signaling that there was a problem coming in the economy. But we didn't think that was the case, and not everybody appreciated that at the end of the year when high yield was selling off, high yield leverage was at a cycle low and high yield profitability was at a cycle high. So that actually really created an opportunity in the markets. And the opportunity was created both in equities and in credit. So in equities, we have seen some improvement in valuations, but the real story on what happened with equities, and this is one of the times where a bell was really kind of rung to pay attention. The valuation compression that we had in the fourth quarter of 2018 has only happened 20 times in the last 90 years. 15 of those 20 times, you had a great outcome the next year. 5 of those 20 times, you had a bad outcome, including 3 of them being after the Great Depression, or during the Great Depression. So this really was a chance to make a call, and the view that we took, which so far the market seems to be embracing, is opportunity was created. And one of my favorite areas for investing, especially for people that have got extra money that they've had on the sidelines, are nervous about getting fully into the equity market, is in high yield, where we think that the risk-adjusted return potential is excellent. So if we look at the historical experience of how high yield bonds have performed after they've had a big sell-off, the big lesson is the worst thing you can do is sell high yield after it started losing money. Because the longest it's taken you historically to get back to break even is 9 months. So the benefit of that coupon over the return that you may get from changes in the valuation of the bonds really pays off quickly. And as we look out over the next 12 months, we actually have a return expectation for U.S. high yield that is comparable to what we think you're going to get out of the global equity markets, but you're going to get it with a lot less risk. What happened during the fourth quarter of 2018? The S&P down 19%, high yield bonds down 6%. And high yield's up something like 8% this year. So it's really done its job in presenting really good risk-adjusted returns to investors. And we think that some of the consternation that you'll hear, so if you went back and talked to trustees or investment committee members, one of the first things that you may hear as pushback is, oh, well, the leveraged loan market's way overblown. So why would we want to go into high yield? There is some validity to that, but I want you to think about the leveraged loan market in high yield bonds and in floating rate bonds. We own very little in the loan market, and that is an area where there's been much more money flowing in, which means terms have gotten a lot easier. Terms have gotten easier in the high yield market, but also profitability is relatively good, and it does remind of the importance of credit research and an active approach to being able to reduce the exposure to individual issuer risk. Now, I mentioned the issue of stuckflation long term, and what are we seeing in the marketplace today? We're still seeing inflation struggling somewhat to meet targets. And so I want to talk about this for a second because there's a couple knee-jerk reactions people can have around inflation that are just wrong. So here's the first one. Tariffs are inflationary. All right, sounds like it's credible because if you raise the prices on something, that's inflationary, right? Well, let's talk about the actual data. First off, current import prices for the month of May, year over year, and these import prices include the effect of tariffs, down 1.1% year over year. So right now, tariffs are not overcoming falling prices elsewhere. Here's the second one that people rarely think about, the second order, third order impacts. So let's say tariffs go up 25% on an individual product this year. That one little product has a rise in prices. Guess what happens next year? There's not another round of tariffs. So tariffs are a one-time step up in prices, and the definition of inflation is a recurring increase in prices. So you'll see in a little bit, because of our conviction on inflation staying relatively low, we are underweight inflation-protected securities in our tactical portfolio because we don't think that that is going to be an issue. The other angle that I would offer on this, and I happen to be presenting at a conference of a similar size to this, but more on the wealth management side about 4 months or so ago, and Janet Yellen was speaking, and I couldn't listen to her presentation, but I was at a dinner afterwards. And I said, so what did you pick up from listening to former Fed Chair Yellen? And 2 people independently, unsolicited, said, she said that tariffs are deflationary. And I thought, well, that's really interesting, because what it means is the negative impact on growth, if they really get carried away, will overwhelm any one-time step up in prices. Now, a question that we have gotten regularly, and one of the things that has led to all the money that did flow into floating rate debt was, what about the outlook for interest rates? Isn't it only a matter of time before we have a jump in rates? And one of the things that I've really come to appreciate over the last 20 years or so, I came up as an equity guy, but I've had the benefit of weekly meeting with our fixed income team. And they've pounded into my head, focus on growth and inflation, nothing else really matters with interest rates. Don't get turned around by the latest story that China's going to dump treasuries or Russia's going to be doing that. What really will drive rates is the outlook for growth and inflation. And if you look at nominal GDP over the next year, it's going to be somewhat moderated over what we've seen over the last. So we're unlikely to see an upward pressure to interest rates from an increase in either growth or inflation globally. And there's another issue that really provides a ceiling on U.S. interest rates, and that is where our rates are relative to everybody else around the world. As I travel around the globe and ask investors, whether it's in Europe, the Middle East, or in Asia, if you had to put money into one currency and leave it, you couldn't touch it for 3 years, what currency would you buy? 2/3 of the time, they pick the US dollar. So even if you hedge, you're still getting some interest rate benefit, but looking at the US at a 2.4% kind of yield on the 10-year versus Germany at a negative yield, that's going to provide some ceiling on how high US interest rates go. Now, one of the key concerns that the market has had, and certainly the Fed is and should be paying attention to, is the risk of a yield curve inversion. So simply stated, a yield curve inversion, short-term rates rising above long-term rates. And the last 5 times we've had a sustained inversion of the yield curve, we've ended up going into recession roughly 12 months later. Now, why is that the case? Well, it's not entirely clear, but here's 2 theories. The first is, this is the fixed income market predicting a recession around the corner. The second, which is demonstrably provable, is that banks are disincented to lend when the yield curve is inverted, because they're paying short-term rates and they're lending at long-term rates and they're not making money. So a yield curve inversion, we believe, will be some constraint on how far the Fed will go. A relatively flat yield curve, which is where we are today, isn't that kind of a danger sign? But we do think this is one issue that will likely lead the Fed to reduce rates over the next 6 to 12 months. Now, the trade war is dominating the discussion, and it's dominating the discussion really because of the collateral damage that it can create. And so what this chart lays out for you is the major exports out of China and who the exporters are, to try and determine how effective tariffs are. And so if you look at the issue of where tariffs would be effective, chemicals. 68% of Chinese exports in the chemical industry are from Chinese companies. Look at tariffs on computer and electronic products. 13% of those exports are from Chinese companies. That's the collateral damage. That's where companies like Apple end up getting hurt. Now, one of the things that this tariff and trade dispute is demonstrably doing is getting companies to move their production supply chain out of China into other countries. So Apple has moved some of their production by their supplier from China to India. GoPro, the maker of those video cameras, has announced they're moving their production from China to Mexico. So that's certainly part of the cudgel that the administration is expecting to use. But there is a push and a pull here from a tariff and trade war standpoint between what the administration is trying to accomplish long term, which, if you really get down to the end of it, is to a significant extent slowing China's rise, and the flip side, which is the damage to the economy and their concern about getting reelected. So what have you seen over the last couple of days? We have announced we're taking the steel and aluminum tariffs off of Mexico and Canada. We have also delayed the implementation of potential auto tariffs against Europe and Japan by 180 days. And I think that is, to some extent, recognition of the economic fallout that can happen through trade wars. And if you need no more reminder about it's the economy, stupid, look at the Australian elections over the weekend. It's a bit of a replay of what happened in the US in 2016, where you had an expectation that the Liberal candidate was going to win. There was kind of a hidden support for the Conservative candidate, and they ended up winning. That happened in Australia, where the Liberal candidate had a bit of a redistributionist and environmental focus, and the more conservative Prime Minister's party definitely had much more of a we need to grow the economy, and we're not backing off on growing even our carbon-based part of the economy, and they had a pretty significant victory over the weekend. So I think it's a reminder of the importance of the economy, and that, I think, will be some constraint on how far the administration goes on the trade and tariff front. But we expect this fight with China to continue for years to come. This is not going to be a grand resolution that's going to put all these issues to bed, because China does not want to let us tell them what to do. So roll this all up, and how would we position portfolios today where we've got the flexibility to put tactical positioning in place? Major overweight to high yield bonds, overweight to US equities, overweight to global real estate, and you've got to fund that from somewhere, so we're funding it out of our bond portfolio, both investment grade and inflation-linked bonds. So two final topics, risk cases that we're worried about and the lessons learned. So the risk cases, number one is inflation. So I've told you with some conviction, hopefully, that we don't expect inflation to be a problem in the economy or the markets, but if we're wrong, it's going to be a painful mistake, because the impact on interest rates and the impact on valuations will be considerable. So we're paying a lot of attention to that. And the second is the risk of political miscalculation. We could accelerate the trade dispute with China. We could decide to send some carriers through the Straits of Taiwan. And accelerate what's happening with the disputes with China through things like that. China's now looking at potentially doing things with their rare earth exports. So this is an area that we pay attention to the risk of acceleration, because it could be a problem for growth and risk-taking. So the final thing I want to hit on is the issue of lessons learned, the challenges of forecasting, and the benefits of diversification. So we went back, and this was really in response to a client suggestion. All right, well, you've given us your 5-year outlook. You've told this great story. How good are you at actually doing the 5-year forecast? So we went back and looked at what we forecast in 2013 and what actually transpired, and what can we learn from that. So it's hard to pick individual asset class forecasted returns. The developed markets in equities we thought would deliver 7.5%, delivered 10.5% returns. Emerging markets, big disappointment. We expected 10, they came in at 5.5. In the natural resources area, we thought you'd get a little over 7, you only got a 5% return. So you might say, well, geez, what did that mean for portfolios? Didn't that mean that client outcomes were materially off because your individual asset class forecasts were off? You can show clients and investment committee members efficient frontiers all day long, but this actually more clearly explains the benefit of owning a diversified portfolio. Roll up those different asset class forecasts into the risk control assets, so that's cash, investment grade bond, inflation protected securities. We thought you'd get 2.7%, you got 2.1. interest rates rose a little more than we expected. In the risk asset category, which is basically everything else, we thought you'd get 7.7, you got 8.6. So within 90 basis points, not too bad for very volatile assets. Roll the whole thing up into a fully diversified portfolio. We were planning on that portfolio delivering a 5.8% return. It delivered 6.1, within 30 basis points of expectation. So for people planning on their expenditures and growing the value of the base portfolio, the aggregate return really was very close because of the benefit of diversification. So with that, hopefully I've given you a sense about how we tackle the long-term outlook, the value of themes, steady growth, stuckflation, and easy monetary policy. But we expect more moderate returns because of the fact that we've done pretty well over the last 5 years. And the final point is that we're still comfortable putting risk into portfolios today. If we've got fresh money coming in, we're happy to put it to work, favoring U.S. high yield, U.S. equities, and global real estate, and funding that out of the bond portfolio. So with that, I understand we don't have Q&A built into the presentation, but I'm going to be hanging around afterwards and be happy to engage in any questions one-on-one. I thank you for your time, and I hope you have a very productive conference.